Assalamualaikum and salam sejahtera. My name is Afida binti Yusuf and I am from Group 5. Our group will be present about 5 companies, which is MNRB Holdings Berhad, a finance sector, Mainus Holding Berhad, a consumer sector, Micron Steel Berhad, an industrial FGB Holdings Berhad, a plantation sector, and the last one is Bina Darul Aman Berhad, construction sector. The first one is Malaysian National Reinsurance Berhad, is the selected company in the finance services sector. As I mentioned earlier, MNRB Holdings Berhad, the country's national reinsurer, was set up in 1972 to reduce the outflow of reinsurance premium services. Premium overseas. The company commenced operations on 19 February 1973. In 2005, due to a restructuring exercise within the MNRB group, the company's reinsurance license, businesses and assets were transferred to its subsidiary company. According to the restructuring, Malaysian National Reinsurance Berhad became an investment holding company and changed its name to MNRB Holdings Berhad. Today, MNRB is listed on the main market of Bursa Malaysia Securities Berhad. MFRS 108 of MNRB Holdings Berhad. According to the annual report of the company at the beginning of the current financial year, the group and the company adopted the MFRS standards as the previous year. There is no new adoption of the amendment or improvement to MFRS, which are mandatory for annual periods beginning on or after 1st January 2020. These adoptions did not have any significant effect of the disclosure or amount recognized in the group's and the company's financial statement. The group and the company are intend to adopt MFRS 17 if applicable when they become effective. Based on the amendments to MFRS 17, the standard is effective for reporting period beginning on or after 1st January 2023, with the option to apply a full retrospective, modified retrospective or fair value approach on transition. MFRS 110 for MNRB Holdings Berhad. Due to the spread of COVID-19, many of companies was affected. Even the group was not excluded from measures and had taken a number of steps to monitor and prevent the effect of the COVID-19 virus within the group. It has impacted the claims experience of the reinsurance and retakaful business, as well as the business volume of the general family takaful businesses, which have seen a reduction in contributions in the first quarter of the financial year ended 31st March 2021. The property, plant and equipment of MNRB Holdings Berhad, such as computer equipment, office equipment, furniture and fittings, and motor vehicles were initially recorded at cost. Subsequent to recognition, plan and equipment are stated at cost less accumulated depreciations. Any impairment losses whilst properties are stated at revalued amount less subsequent accumulated depreciation and subsequent impairment losses, except for freehold land and building. Valuation are performed with sufficient frequency to ensure that the carrying amount does not differ materially from the fair value of the freehold land and the building at the reporting date. MNRB Holdings Berhad have 2 audit matters which is related to the insurance or takaful contract liabilities and tax recoverable of the group. The key audit matters that related to the group is insurance or takaful contract liabilities as at 31st March 2020 amounted to 5.8 billion as disclosed in Note 220 to the financial statement, or approximately 84% of its total liabilities. These These liabilities have been estimated based on standard actuarial valuation methodologies, and other estimation models are as allowed under the risk-based capital framework for insurer and risk-based capital framework for takaful operator issued by Bank Negara Malaysia, as well as the accounting policy described in notes 2.5, 2.6, and 2.7 for the valuation of the insurance or takaful contract liabilities of the group. The second key matters is tax recoverable of the group. As disclosed in Note 2020 to the financial statement, the group is currently appealing against additional tax assessment and penalties raised by the Inland Revenue Boarding of Malaysia, amounting to approximately 24.9 million. These additional tax assessment and penalties were paid by the group and were recorded as tax recoverable. For financial statement analysis, for net profit margin, as can see in the table stated, the net profit margin of MNRB Holdings Berhad in both 2021 and 22 are positive, with the difference by 1.47% due to the huge increasing of net profit in 2021. The current ratio of MNRB Holdings Berhad is increased from the year 2020 to the year 2021 by Rm 2.48 ringgit to Rm 2.60 ringgit. Even the increasement only 0.02 cent, but it shows that the company is in action to have a good financial health. The debt-to-equity ratio of MNRB Holdings Berhad shows that there is a small increase from the year 2020 to the year 2021 by 0.03 times. The debt-to-equity ratio is in the year 2020 is more favorable for MNRB Holdings Berhad compared to the year 2021. A lower debt-to-equity ratio typically reflects a company's financial stability. Hence, it shows that MNRB Holdings Berhad is more financially stable in the year 2020. That's all from me. I pass to the next presenter.
Good day, doctor. My name is Tan Tong, metric number 284640. So I will continue to discuss about the application of MFRS by my new holding Berhad. So first of all, I have to know a bit about the company's background. So my new holding Berhad is a selected company in the consumer product and service sector. It is a Malaysia chain of convenience store. Its first flagship store opened on December 25, 1996 and was founded by Tang Tai Lok. My new strive for excellence in the convenience store industry by comprehending consumer needs, offering high quality product and guarantee a positive shopping experience. Next is discuss about the application of MFRS by my new holding Berhad. First is MFRS 108, Change in Accounting Policy, Accounting Estimated and Errors. According to the annual report of my new holding Berhad, the group and company adopt new MFRS standard amendment and improvement at the start of the current financial year. So the group has chosen to adopt MFRS 16 COVID-19 modification before they are due to become effective on or after 1st of June 2020 and 1st of April 2021 with regard to rent concession. Next is there is the year 2020 and 2021, which has the subsequent event in accordance with the MFRS 110. In this both year, the company significantly impacted by the COVID-19 pandemic and the financial performance has been negatively impacted by the operation being destroyed at the time of the several MCOs. Fortunately, the group has granted some rental rebate by some of the landlords and successfully managed to obtain total rate subsidy under pre-hardened rate subsidy programs. So as a result, such event known as non-adjusting event because the group determined that the COVID-19 outbreak did not present significant evidence of a condition that occurred on or before the reporting date. Next is MFRS 116. Based on the company financial year of 2020 and 2021, the property, plant and equipment are measured using cost model, except land and building. Land and buildings are measured using revaluation model. so that the depreciation of PPE is recognized on the straight line method. Freehold land is with an infinity life, so it is not depreciated. While for capital work in progress concerns renovation of other premises in progress, so it is measured at cost and not depreciated until they are completed and ready for their instant use. And there is no impairment of asset on this company, so that there is no application of MFRS 136. Next is critical audit matters. There are three key audit matters for my new holding Berhad. First is the risk of valuation and assistance of inventory. The assistance and valuation of inventory were audit focus area due to the large number of audits where inventory were maintained and the valuation methodology used, which measure at the lower of cost and the net residual value for inventories. Second is revenue involving enormous volume of insignificant transactions. Because the amount of revenue from cash sales is important to the group financial statement, and because processing a large volume of relatively small transactions through the group's information technology system is involved, it is considered to be a key audit matter. Third is the right of use asset analysis involving significant volume. MFRS 16 lists it regards as a key audit matter because it requires the management to extract a sizable amount of data in order to prepare the leases schedule. Lastly is to discuss about the financial statement analysis for my new holding Berhad. First is profitability analysis, which discuss about the net profit margin. As you can see, there are negative net profit margins for both year 2020 and 2021. So that it indicated that the incapacity of company to manage expenses due to the company having a net loss in both years. Next is liquidity analysis, which discuss about the current ratio. The current ratio for 2020 is 1.34 times, while for 2021 is 0.95 times. So that we can say that the company is in good financial health and has the ability to pay off its debt with its current asset, especially in 2020. Last is solvency analysis, which discuss about the debt to equity ratio. The debt to equity ratio for 2020 is 0.85 times, while for 2021 is 1.04 times. So that we can say that the debt to equity ratio in the year 2020 is more favorable compared to the year 2021. So that's all from me. I will pass to Hui Shan to continue discuss about other companies. Thank you.
Good day, doctor. My name is Chai Hui-shan, metric number 288916. So I will continue with the company Micron Steel Berhad, an industrial product and service sector company. It was a public limited company established in Malaysia on 24 July 2003. Its primary activities are investment holding and provision of management service for the combined activities of three subsidiaries, Micron Steel, CRC Sendirian Berhad, Melawar Steel Tube Sendirian Berhad, and 3, and Silver Victory Sendirian Berhad. We had analyzed the annual report that stated that the company had changes in accounting policies. So in financial year of 2020, the company applied the conceptual framework for financial reporting, revised 2018, amendments to MFRS 101 and MFRS 108, definitions of materials, amendments to MFRS 3, definitions of a business, amendments to MFRS 9, MFRS 139, and MFRS 7, interest rate benchmark reform, and amendments to MFRX 16, COVID-19 related rent concessions. While in 2021, the company applied amendments to MFRS 9, MFRS 139, MFRS 7, and MFRS 16, interest rate benchmark reform, phase 2 in the accounting reporting. For the MFRS 110, first of all, due to the COVID-19 pandemic caused the shutdown of 6 weeks operations, which impacted the group's financial performance in 2020. So the pandemic worsens in 2021 and forcing the business to close for 10 weeks. This led to a reduction in sales volume. So the company group declared it as a non-adjusting event, and the results are disclosed in the appropriate notes to the financial statements for both year 2020 and 2021. For the MFRS 116, the company applied a revaluation method for the freehold land, buildings,
plant machinery and electrical installation, and apply cost model in motor vehicles, furniture, fittings, and office equipment for both years 2020 and 2021. Next is the MFRS 136. The company incurred impairment losses of PPEs by comparing the carrying amount of these assets with its recoverable amount and measure it at a high fair value less cost to sell, and the value in use in assessing the impairment of cash generating units. Besides, there are two critical audit matters disclosed in the annual report, which is the valuation and impairment assessment of land and building, plant machinery and electrical installation. We had determined the financial analysis ratio of the company. For the net profit margin ratio calculation, we know that the company is more profitable in the year 2021 compared to the year 2020. Next is the current ratio analysis. With a 0.9 times increase in 2021, we can give opinion that the company is in good financial health and has the ability to pay off its debt with its current assets, especially in 2021. Lastly is the debt to equity ratio. The lower is more better and more preferable. So with a slightly increase in 2021, we can say that the debt to equity in the year 2020 is more favorable compared to the year 2021.
Hi and Assalamualaikum. My name is Nurshaya binti Azizi and my metric number is 288043, and I will be presenting application of MFRS by FGV Holdings Berhad. Felda Global Ventures Holding Berhad, known as FGV Holding Berhad, is a Malaysia-based agriculture business on 28 June 2012. FGV's principal operations are in three business sectors: oil palm plantation and refineries, rubber production, and sugar products. They aim to ensure they can offer value to customers and stakeholders. Their mission is to be a global leader by value adding through their human capital. According to MFRS 108, changes in accounting policy, estimates and error for financial year of 2022, the company decided to adopt two policies. First, MFRS 101, presentation of financial statement, and MFRS 108, accounting policies, changes in accounting estimates and error, definition of material. Second, MFRS 3, business combination, definition of business. For financial year of 2021, the company decided to adopt two policies as well. First, MFRS 16, COVID-19 related rent concession. And second is MFRS 9, MFRS 139, MFRS 7, MFRS 16, interest rate benchmark reform, phase 2. MFRS 110, events after reporting period. On 8 May 2020, the Board of Directors of FGV announced that FGV Trading Syndrome Berhad, FGVT, a subsidiary of FGV Plantation Syndrome Berhad, which in turn is a wholly owned subsidiary of FGV, had entered into an agreement with Pre-Unit Private Limited (PREU) to establish an operation in India. Within 6 months from the date of agreement, a company will be incorporated in India to carry out the intended business. MFRS 116, property, plant and equipment. All of the assets are stated at cost less accumulated depreciation and impairment loss. Major spare parts, standby equipment and servicing equipment are classified as property, plant and equipment rather than inventory when they are expected to be used during more than one period. Barrier plants are classified as immature until the trees are available for harvest. At that point, the barrier plants are measured at amortized cost and depreciated over their useful life. All direct costs for canning are accumulated until it matures. Subsequent to that, the costs that have been capitalized are amortized based on the straight line method over its expected useful productive life. All property, plant and equipment are depreciated on a straight line basis to write off the cost of each asset to their residual values over their estimated useful life. There are three critical audit matters for FGV Holdings Berhad, which are Land Lease Agreement (LLA), Liability Assessment. As at 31st December 2021, the LLA liability for the group amounted to 3.8 billion. The fair value of the LLA liability is calculated based on cash flows projections. Net, Goodwill impairment assessment. As at 31st December 2021, the group's carrying value of goodwill of 809.1 million comprised goodwill in relation to sugar business in Malaysia of 576.2 million, palm upstream operation in Malaysia of 226.8 million, and other operation of 6.1 million. Other than that, impairment assessment of non-financial assets with impairment indicators, which resulted in impairment losses of 59.6 million. For financial statement analysis of FGV Holdings Berhad, under profitability analysis shows that net profit margin in both years recorded high percentage. However, FGV Holdings Berhad is more profitable in the year 2020 compared to the year 2021. On the liquidity analysis, it shows that current ratio in the year 2020, 1.89 times, is increasing to the year 2021, 8.47 times. This shows that FGV Holdings Berhad is in good health and has the ability to pay off its debt with its current asset in 2021. On the solvency analysis shows that debt to equity ratio in the year 2020, 0.34 times, is decreasing to the year 2021, 0.28 times. They show that the debt to equity ratio in the year 2020 is more favorable compared to the year 2021.
My name is Nur Aina Alibah binti Junaidi. My matric number is 288060. I will present the application of MFRS used by Bina Darul Aman Berhad. Bina Darul Aman Berhad is the selected company in the construction sector. BDB is an investment holding firm with well-known businesses in infrastructure, engineering, building, real estate development, construction and tourism in Kedah. This business was built on 7 January 1995 and listed on the main board of Bursa Malaysia on 2 February 1996. The BDB Group has significantly contributed to the state socio-economic agenda since its establishment more than 20 years ago by realizing outstanding achievement in implementing various projects in different parts of Kedah. Regarding the MFRS 108 changes in accounting policy, estimates and error, BDB has chosen to adopt MFRS 16 leases COVID-19 related rent concession that take effect on or after 1 April for year 2020 and take effect beyond 30 June for year 2021. MFRS 110 event after reporting date, coronavirus pandemic that started on March 2020 had causing significant global social and economic disruption that uncertainty, including in markets where the group and the company operate. The effect of COVID-19 have an influence on the groups and companies' activities during the fiscal year. While the pandemic's implications continue to grow, the group and the company are continually monitoring and managing their operation in order to respond to these changes and minimize any damage that may arise. In the opinion of the directors, the businesses has not been materially affected by any item, transaction or event of a material and unusual nature, nor has any such item, transaction or event occur in the interval between the end of that financial year and the previous. Regarding MFRS 116 property, plant and equipment, the group applied the revaluation method for the leasehold land, building, plant, machinery and electrical installation, while the cost model is used in motor vehicle, furniture, fitting and office equipment. Leasehold land with an infinite life is not depreciated, while the others is depreciated on the straight line method. By looking at the disclosure under MFRS 136 impairment of assets, the policy on impairment of BDB that is provided in the financial statement is that when the carrying amount of an asset is assessed and written down immediately to its recoverable amount, it indicates the impairment has existed. Regarding the annual report, there is no impairment in 2021, while there are impairment losses of a much as 148,000 ringgit Malaysia in 2020. For the critical audit matter, BDB recognized revenue on sales of properties under construction by referring to Notes 2 and Notes 19 in the annual report. For the year 2020 and 2021, BDB has determined that there is no key audit method in the audit of the separate financial statements of the company to communicate in their auditor's report. Lastly is discussion regarding financial analysis for BDB Berhad, which is profitability analysis to measure the net profit margin. As you can see, both years show a higher positive ratio, but the company is more profitable in the year 2021 compared to the year 2020. The second one is liquidity ratio to determine the ability of an organization to pay its bill in a timely manner. Both years show a high and positive ratio. That means BDB has the ability to pay off its debts with its current asset, especially in 2021. The last one is regarding leverage analysis, which is debt to equity ratio. Bina Darul Aman Berhad is more financially stable in year 2020, but both ratios are less than 1, proving that it has less risk to be borne by the companies. That's all from me. Thank you.